welcome. You're watching Your Trades, and this is Priyanka Pal along with me, Shriyanji. Shriyanji, it was not at all expected. In fact, we've been talking about October seasonality, which is historically, which has closed with gains more than 8% for every time last 10 years. But then this looks to be a rough start, and this rough start starts from global markets. Now, the kind of fear that we've seen in markets, not just coming in from the FI's outflows, even money moving to China because China has been stimulating its economy. We have seen a bad hammering on Indian markets, at least today. Trend for Nifty, Bank Nifty, both looks like a short build-up. In fact, this is the biggest intraday fall since August 5th. Around about 10 lakh crore of market cap was wiped out today. Nifty opened lower with a gap down, kept on dragging down to shut stop at nearly below 25,300. Bank Nifty closed with 1100 odd points dragged down. In fact, banks have been plummeted the most. If you notice, just last 3 sessions only, they've lost nearly more than 200 points, precisely near 2400 points, nearly 5% of the losses done on Bank Nifty. Banks have been hammered the most, and not just this, broader markets was giving you a sign in the month of September only that there was some sort of weakness despite markets scaling new highs. Mid cap and small cap was not participating in that with that exuberance. But anyhow, for talking about today, all the sectors closed in green with infra, auto, realty, PSU big. They are closing in deep red now. And of course, the three big reasons, the major of the reason coming in from the macro factor. But do it looks like a major breakdown on a longer term basis? We'll find it out. Kunal will also join us in. But then right now, the major reason which is spooking fear in Indian markets, and that was also a reason that we saw nervousness on Tuesday, was a SEBI framework. The SEBI tightening on the derivative, on the F&O segment, that has clearly played out in F&O stocks, and of course a major of the F&O stocks coming from broader markets also. Shriyanji, so not a good day for at least for bulls at least. For bears, it was exceptional day because the kind of premium we've seen in F&O only.
Absolutely, yeah, that just about sums it up, right? But then, you know, when you take a look at what else was happening in the market, quite the interesting trade that we saw happening, and there were a host of counters aside from the terrible Thursday that were in focus. Now, of course, there's important commentary as well that we should be looking at, because the Indian Steel Secretary also talked about anti-dumping duty, and he told your channel about the investigation for imposing anti-dumping duty on steel imports that has started. Decision on higher import duty will be taken as per process, and that's what he said. And he said that he can't comment on the timeline as such, but the ministry can assure that it will happen soon. So that's important commentary coming in from Indian Steel Secretary Sandeep Pondrik. Of course, we'll be playing that for you later as well. But let's also take a look at how the second quarter really shaped up for a host of counters. When you take a look at Dabur as well as Yes Bank, you did see some disappointment coming in, because when you take a look at mid-single digit decline is what you're seeing for Dabur. And when you take a look at the stance coming in from brokerages as well, of course, there was Morgan Stanley that maintained an equal weight rating. Investec maintained a hold as well. And that was the kind of commentary that has been coming in for Dabur from brokerages as well. And that counter was on brokerage radar. But there was Yes Bank as well. That was in focus on account of that loan book update coming in, 13.1% uptick on a year-on-year basis. In terms of deposits, 18.3% on a year-on-year basis as well. When you take a look at auto sales, of course, you did have Hero Motor reporting numbers that beat estimates. So you're looking at 6.37 lakh versus 5.3 lakh units that were being penciled in. Uptick of about 19% on a year-on-year basis coming in for that one as well. But when you take a look at the stock, not doing all that much in terms of taking a cue coming in from this auto sales number being above estimates, but that largely is the kind of handover that we saw, right?
Absolutely. In fact, now let's just understand that where is the immediate support that lies, because we've seen the lower strikes being sold into. In fact, 25,300, 25,400. Trend has changed for Nifty. Kunal has joined us to talk about the levels and of course what to expect going ahead. Kunal, did this surprise you? Because, you know, in the morning we could see that there could be a chances of a lower opening, but then this fall, did it surprise you? It had it was a free fall. It appeared as a free fall today.
Yeah, the selling was quite intense throughout the day. You know, in the start, I assumed that maybe I think closer to the 25,500 mark, 25,400 mark, where we opened 200 odd points on the downside. I think we could probably find you know, some bit support for the indices. But there was incessant selling from, you know, few large cap names. So, you know, we looked at the data, for example, on the larger cap front, there are 4 stocks now on the Nifty 50, and four of these stocks constitute almost 15% weightage for the Nifty. They are now trading below their 200 moving averages, and three out of the four names have fallen below their 200 moving averages today. So that includes the likes of Reliance, L&T, Tata Motors, as well as IndusInd Bank. These are the four names which are trading below the long-term moving averages. Now, that generally is one point of concern, because when more number of stocks from a benchmark indices, when the proportion gets into a higher side, when the stocks break below the long-term moving averages, we see the effect coming into the benchmark indices. So my sense is that over the next couple of days, what we need to look out for is that whether there is aggravated selling into other large cap stocks, whether it trickles to the other sectors. If that happens, we could be looking at a point where the index may fall up another 250, 300 odd points at least over the very near term. So not expecting an immediate revival into the markets, but I think closer to 24,800, 24,900 is where I would peg the first support for the index.
All right, so that's about the markets. But when you take a look at the larger IT pack as well, Kunal, what you're looking at is that in tandem with what we've been seeing with the market, we've been seeing the IT pack as well fall. So is it time to buy into the dips? Are you looking at some stocks from that particular pack then?
So, the first port of call is that whenever the markets fall into a corrective mode, drop the beta of your portfolio. And the best way to do is look out for defensive names, because defensive stocks and the ones which have low beta, they are the best ones which can shield your portfolio to a larger extent. So I think in that sense, yes, the IT index and the IT stocks on the large cap front could be something which you can bet on. So I would look out for TCS as a buy at current levels. The stock forming looks like forming a base at this 100, 4250 odd mark. So would look out for targets in the range of 4,340 for TCS, and stop loss could be kept at 4160. And the second stock which I'll be bullish on would be Jubilant Pharmova. That's a chart which is looking attractive. Over the last 1 month, we've seen an excellent pickup of price action volumes for the stock. Currently trading at 1190 approximately. Would look out for targets in the range of 1250, and stop loss could be kept at 1160 mark.
All right, so these are the two trades, two recommendations coming in from the defensive space right now. But then, of course, this is the surprising fall, and that's in fact, that's the second biggest fall after June 4th. That's what I was noticing. But Kunal, just to take one more minute, what interesting fact I was going through is that October has been seasonality very strong for Indian market, but not for the US markets. In fact, that there's the kind of data which suggests is that October is seasonally bad for US markets, and that could play out again this time.
No, I think in fact last month, October, the seasonality is not played out for our markets. Now, when we looked at the data, September seasonality indicates that the Nifty closes on a negative front. But we closed on a much more positive front. We recovered from the first week of correction for the indices. So I think it doesn't come as a surprise that the markets are going through an aberration phase, where the month of October could also play out a bit different for our markets.
Okay, so should we prepare for more sell-off in the October month? At least a sign of cautiousness, what has been played out today. Thanks very much, Kunal, for the view and the two recommendations here. But then let's get you more voices. Sandeep Tandon, CIO for Quant Mutual Fund, he also spoke about where he is finding opportunities amid uncertainty. And listen what exactly he spoke.
We have skewed our portfolio towards the consumption name, particularly the FMCG, some amount of pharma, some amount of insurance, some amount of hospitality or healthcare, the hotels, hospitals. These are tourism. These are the names which we think is safety is much more. And obviously, given the background what we are in right now, we have been very vocal that I like to see my portfolio to be more liquid.
All right, then. With that, it's time for a very quick breather on the show. When we come back, we take a look at some more stock-specific action that we went throughout the course of the day, so stay tuned.
Welcome back. You're watching your trades, and now let's understand how the action from the derivative space looks like. For sure, the trend has changed. Nifty, the short built-up trend, it appears. Banks were not confident. If you watch on the trend for the last week also, the trend was mild buying, or it was unwinding. But then now it is clearly a short built-up, and that's what we saw. The maximum of the damage which came in from the banks here. Now the India VIX is around 13. It has shot up 10% today. Now the lower level of calls are also, the lower level of strikes are also being sold into 25,300, 25,400 massive call writing, and now these happens to be the resistance zone also. In fact, we closed below 25,250 also, which was the low point after June 4. and doesn't seem to be a support if you see, because the puts have been bought in for the strikes like 25,100, 25,200. So it looks like there could be more nervousness coming in, because immediate supports is not appearing, at least from the action coming in from the derivatives.
Well, absolutely. So a little more weakness is what we're penciling in when it comes to the derivatives roundup and how that is largely shaping up. But of course, market watchdog SEBI has unveiled a 6-step framework to regulate high-risk derivative trading. This move includes increasing the contract size to 15 lakhs from 5 to 10 lakhs earlier, and also limiting weekly expiries to 1 per exchange. How will this 6-step framework really impact F&O trade as well as key players in the capital market space? Then Sharad is joining in with that explainer. Sharad?
Well, yes, as per Jeffries, the SEBI's measures has been taken to do a calibrated tightening in the F&O market, and the impact analysis states that roughly 35% of the total industry premium, which is on a weekly contract basis, are likely to get impacted. Now, the key deviations versus the earlier proposals which had come in the consultation paper, the two important things come out. A lower hike to expiry day of margins is of 2%, and earlier it was of 8%, and also the lot size hike, that is almost of 2 to 3 times. Earlier it was expected to be 3 to 4 times. Now, the most impacted players are expected to be discount brokers, followed by the exchanges. But now let's look at how the implementation is actually going to pan out going ahead, and there are certain timelines which need to be understood. On November 20th, 2024, 3 important things will happen. Extreme loss margin will be hiked by 2% for short option contracts, and the minimum contract size for index derivatives is also expected to increase. There will also be rationalization of weekly index derivative products to product per exchange. On 1st February 2025, 2 important things will happen. The first one being removal of calendar spread treatment on expiry day, and also the upfront collection of option premium from buyers by trading or clearing members. Lastly, on 1st April 2025, intraday monitoring of position limits would be there. To simplify, discount brokers like Angel One, Zerodha, there's a high potential impact coming in, and also Angel One in the listed space. Traditional brokers will have low potential, such as MOFSL, ICICI Securities. Exchanges, BSE, NSE, they will be highly impacted. While if you look at wealth managers, AMCs, depositories, RTAs and clearing members, there's expected to be little or no impact at all.
All right, that's how the stocks in the spaces also reacted to the news. But then now let's go across and listen in to what ET Now's editor-in-chief Nikunj Dalmia has to say on this SEBI tightening.
What has come out as a regulation is in line with what the earlier recommendations were, right? So there is nothing new. Markets knew this was coming. And why is the regulator in this case trying to perhaps lean towards this direction? Because the F&O activity is becoming more like a systemic issue, and the fact that the kind of activity in the turnover levels, the turnover numbers which we are getting, especially from the retail level, I think is nothing, sort of scary. So I think the attempt here is to purely, it is really focusing on the participation behavior, at least by a lot of retail traders. The attempt here is to bring the volume down, take the hurdle higher, so that there are some entry barriers which are getting created. The idea is to reduce weekly expiry, is to bring the number of weekly expiries down, which will automatically have an impact on the total, trading and the total volume transaction. The attempt here is to bring the speculation down. Now, the regulator cannot put a gun to your head and say that, you can't trade. All they can do is that they can perhaps make it hard. They can increase the entry barrier so that the participation comes at a cost, and this entire weekly expiry, which was leading to more speculation, and it was almost like a casino kind of an activity which has started there, that will start reversing. From a market standpoint, of course, if turnovers they come down, it will have an impact on direct brokerages. It will have an impact on liquidity in the near term. But then markets, I think, would look beyond that, because nothing has come which is scary, nothing has come which is new. It will be implemented in a very phased out manner, and I think this had to be done because F&O activity in India had almost becoming like a mass addiction. I'm using the word addiction very, very carefully and consciously here. Why? Because that is what data is indicating. The idea here is to change the behavior, and the idea here is to take the entry level higher so that the cost of transaction increases.
All right, so Nikunj had a very clear view on this that of course this was the market knew that this were coming. So majorly it looks like that the tension and the nervousness that is because of the macro reasons, especially the China. The funds could see an outflow. FI's funds could see an outflow because of the entire China market surging. Now, but then let's understand that why metals were in focus today, because there were few of the bullish brokerage notes. In fact, metals had the immunity today for the day like a typical day like today, which saw a turbulent time, because Nomura as well as Morgan Stanley both came up with two important notes on metal space, and especially the steel producer. They said the steel sector, steel players, they are at a sweet spot, and they've highlighted 2-3 very crucial things here. Steel companies are on a path to deleveraging the balance sheet. The domestic demand is rising. In fact, the cyclical recovery is at play. Higher ROEs, improved ROCE on brownfield expansion. That's an incremental one. Now, all these reasons are being a typical case for the higher multiples for steel companies, and also the global monetary is easing. Nomura had a constructive view, and we saw JSW Steel, JSPL. In fact, the steel space, that was immune to today's fall. Like JSPL was up 1.5%. JSW was also up by 2.5%. Morgan Stanley also sees green shoots for spreads, at least in near term, and they see an uptake for another 30 days also. They've upped the target for their overweight on JSW Steel. Target is 1150, and they're talking about on the same lines, China stimulus as well as domestic prices, which are similar to the import prices. There is in fact a parity now. So, lot of green shoots for in fact the entire metal and the steel pack that we saw, and the stocks reacted to these two notes also.
Well, absolutely, and that is something that we saw happening. Let's also then listen into what the Indian Steel Secretary then had to say, because he's also talking about the whereabouts of the steel sector, both in terms of demand pricing and an overview of what really lies ahead for the space. Listen into a slice of that conversation with him then.
We are expecting 300 million tons of steel producing capacity in the country. And in fact, till when we are doing a midterm review of steel policy, we expect that the demand or consumption will be more than what we had anticipated in 2017. So coming back to your question, yes, I think it's a cyclical nature of maybe more due to monsoon and other aspects, because the infrastructure push, especially from Government of India, also from state governments, if you see Sagar Mala project, if you see Bharat Mala project, other projects, the PM Awas Yojana from Government of India, similarly state governments are coming out with their own infrastructure push. And if you refer to the this year's budget, there is a significant amount of roughly 11 lakh crores for infrastructure. So with all this, I expect that the steel demand will continue to grow and perhaps more than what it has been in recent years.
All right, and there you have it. So that's the word coming in from the Steel Secretary. Moving on, then Dabur was reeling under pressure on the back of a weak second quarter and cautious brokerage notes as well. Meanwhile, Angel One also did jump, and we'll be covering a little more on that as well. Varun is standing by with all of those important details then. Varun?
The quarterly updates given by Dabur are weak, and the commentary by the brokerage houses are a little worrisome. Now, let me tell you the update that the company has given. They are saying that because of heavy rains and floods, the out-of-home consumption has been impacted, and impact has been seen on the beverages business. Also, they are expecting mid-single-digit decline in revenue led by India business. The international business, if you look at that is going to show good growth, but the India business has been largely impacted. Also, the EBITDA margins, if you look in Q2, they are expected to decline in mid to high teens due to operating deleveraging. So, the update given by them is weak. On that, we have notes by Morgan Stanley and also by Investec. Morgan Stanley has maintained equal weight with a price target of 772, although they have not cut the price target, but yes, they have highlighted that the overall update given by the company is really worrisome, and they will wait and watch. And Investec has maintained a hold on the stock with a price target of 638. Investec says that they expect revenues to decline by 5%, India volumes to decline by around 10%, and the EBITDA and profit to decline by around 15 to 17% in this quarter. So the updates are weak and the commentary by the brokerage houses are a little bit worrisome, and that's the impact that you're seeing on the stock.
Dabur was hammered badly, 7% lower, just because, of course, they gave us a bad comment, and then the brokerage notes also came in, which supported the fear against the stock, and that's how we saw. But then Angel One, the stock was certainly zooming in today, and that to be a reverse action. If you see the kind of SEBI tightening on the FNO and the derivative norms came in, ideally it should have been a negative trade for these broking counters. But Angel One, because Investec has come out with a brokerage view on the stock, as they've come out with a brokerage note on the company, they've given a buy stance, and they also have hiked the target price for the stock. Now the reasoning that they've given is, the target price earlier was 2,500, now it is hiked to 3,000, and the reason is that they've upgraded the FY26 PAT estimates to 7% by 7% now, and they say even though they see 25% decline in the FNO norms, earlier it was 30%. So that's one key trigger which actually lifted the stock up, and they talk about the price hikes also, which will reduce the impact of the regulatory changes. So the regulatory changes ideally have capped the negative impact on the stock, which could have been possibly because of the SEBI tightening. And these are the levers which are driving the revenue up possibly, and hence they've given a target which is now 3,000 and earlier was 2,500.
Well, absolutely. It does look like Investec is quite bullish on Angel One, but let's also take stock of the counters that were buzzing away in trade. Gaurav is standing by with that list. Gaurav?
Well, yes. Let's begin our list with ITD, because this company has won an order to build a multi-story building, commercial building in UP worth 1900 crore rupees. As a result, we saw the stock was up almost by 19%. Up next we have is Ashoka Buildcon, because this company also won 3 EPC orders from MMRDA, and the total value of these 3 orders is going to be above 1700 crore rupees. As a result, we saw some uptick in this counter as well. Up next we have is Alembic Pharma, because this company got a US FDA approval for a drug which will be used for the treatment of seizures, and the total market value and market's opportunity for this drug is going to be somewhere around $163 million. As a result, we saw some uptick in this counter as well. Apart from that, let's also watch out for some stocks which are buzzing on the back of the monthly and quarterly updates. So first, let's talk about Maruti Suzuki. Here we saw some weak set of numbers from the company. So when we talk about the production numbers, that declined almost by 9% on a YOY basis in the month of September. As a result, we saw some stock pressure building up in this stock. Next, we have is some of the banks. So first, let's talk about PNB Bank, because when we talk about deposits, that increased almost by 11% on a YOY basis for Q2 FY25 according to banks pre-quarterly updates, while advances increased almost by 13%. And when we talk about Yes Bank, there we saw loan book increase of around 13%, while deposits increased by 18.3%. But let's not forget that the system has increased its advances growth, has registered at 15% for July and August. And on back of this, let's also watch out for these banks as well. So definitely we'll be watching out on all these companies on the back of the business update as well as the news flow that we have received today.
All right, thanks very much, Gaurav, for all that updates. Of course, Maruti, what was coming in, market and the market participant could see it earlier. That's the kind of slowdown which we've been anticipating, and that's now reflected in the volumes also. Well, that's all in this edition of Your Trades. Thanks so much for watching. Stay tuned for more business updates. Do it now.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.